here. It's always fun around my house when my kids hear these webinars going down. They come in here and try to mimic all the accents that they're hearing. It's always a good time to see how close they can get. All right, let me get this
Well,
straight.
I'm used to whenever I call into a help desk, I'm used to people identifying me instantly by my accent. So, having been in Australia for the last couple of weeks, doing a little travel, I keep calling into help desks and saying it's me calling back, and I've been surprised that no one knows who I am anymore because I'm just one of the others.
It's Johnny. It's Johnny. Johnny Aussie. All right, y'all.
It's
This is
me. All right.
John. Can everybody hear John okay? Hey, Walter. This is my Walter. Let's see, Walter's here. Stan. Ramesh, let's do a sort of a repeat. Y'all tell me where you're from. Everybody pipe in where you're from. I'm in Mobile, Alabama. And, John, I don't even know where you are right now. Are you back in?
I'm actually sitting in the back of my camper van on the coast of Victoria.
Okay, well, I once did a webinar from the back of my Yukon in a Starbucks parking lot in Birmingham when my Wi-Fi wouldn't work. So you can see me, imagine me in the back of my Yukon with the window popped up slightly with my headset on, facing my laptop as the people come in and out. I'm sure they probably thought I was, somebody important. But anyway, that's my camper story. All right, let me give you the access to be the man for a second. Let's see.
Oh, right. I get a whole hour of being the man, Jeanette.
Heck yeah. How is it 35 degrees in my town and there's a mosquito in my office?
Has everyone got that? Everyone got the screen up?
All right, let's see. Not yet. Where's coming? All right, there it is. Okay, I see it. And I'm going to mute my mic. You have 1 hour. Y'all welcome John Seville, Acorn Wealth Corp.
Right. Okay. So, welcome everyone, and good to have everyone here, and we'll get cracking. So, today is one of my favourite topics to talk about. As Jeanette said, she's heard me present this a couple of times because it's one of these things. It's not a planned product. It's not something that we kind of have put together that we offer all the time. It's a webinar that's very specific to what's going on in the economy now. And I'm going to take you through the process of thought that has gone into what we see happening by the books, not by thoughts, but by the books, what indicators we use, and why we feel that putting all this together is indicating that we've got a potentially big crash coming, which we've called the big one. Now, how many people here have never heard me speak before? How many people are brand new to Acorn? Just to get an idea of how many newbies we have. And yes, good day, Karen. How you doing? Good day, Kega. All right, cool. So most people are familiar with us. All right. So yeah. So look, real brief. We've been around since 2007, and as anyone who knows me will know, I don't believe what I think matters. Not because I'm down on myself or anything like that, but I believe that whatever opinions I have of the market are simply mine. Whether I'm right or wrong, it's the big money that matters. And whether they're right or wrong, if they start buying or selling, that's where the market will go. So all of our strategies that we profess and teach are all based around a very high focus on looking at where the smart money is going. And of course, when we're looking at key corrections in the market, the smart money is extremely important with major moves. So we're going to be talking about these major moves. We're going to talk about live market conditions. So of course, if there's any specific questions you have about stocks or things you may be interested in, save them up for the end. We're going to have a full-on Q&A where you can pick my brain and we'll have a look at the charts. But it is for educational purposes only, of course. All right, so let's get cracking. How did this all start? Well, I mean, let's put the debt aside for a second. Let's just talk about the most obvious things that are in the headlines at the moment. Let's look at the Asian economies. I mean, we're talking about stupendous growth. I mean, and I'm pretty sure no one in this room believes the figures that China's claims they've been growing at anyway. But let's say that we did. One thing that isn't disputable is that that's come to a grinding halt. So we're talking about a decade of growth that, bam, hits a wall. Now, I mean, China's no small speck in the ocean. They account for a huge amount of global demand. Yes, the US is huge, but so is China. And of course, that's a big problem that has been building in the background for quite a while. Obviously, we have the overseas events as well. I mean, the issues that the terrorist activities have been going on in France that are now causing a massive spike down in consumer confidence. I was listening the other day that consumer confidence is now has dropped significantly, and that can be because of a number of factors. But we have fear-based threats, consumer spending-based threats, real economic threats, of course, from collapsing European economies and Brazil and all these other things. So we've got the news building, the looming cloud, if you will. Now, just before we go on, there's the problem with that is that those are just ideas, right? Those are just ideas. I mean, who here in the room would agree that a lot of people had been waiting for the US economy to correct? Well, I won't use the word crash. Let's say correct. We've been waiting for the US market to correct to a more reasonable level for years now. I mean, who would agree with that? That they've been waiting for the crash since 2010, since 2012 maybe. But nevertheless, we've been printing away the money, and we've been able to continue the upward mark. But it's kind of like hair of the dog. You know, you can only wake up in the morning and cure a hangover by drinking another beer for so long until you finally got to face the facts. And printing more money has been able to prolong the rally. It's been able to push the problem further off and kick the can down the road. But this is going to come to a head one day or another. So how do we time that? And what are the catalysts for that major correction to start? Well, let's talk about the fundamentals first. Let's talk about that, and then we'll go to the charts. Fundamentally, when this comes to a boil, the first catalyst that really starts to push to make things drop is going to be bankruptcies, because as credit tightens and international business becomes more difficult, or demand prices become so low on resources, whatever the case might be, you start to get major bankruptcies. Those bankruptcies create a domino effect where highly leveraged companies start to then follow suit. Credit then tightens. Companies find it difficult to borrow. Consumer confidence drops. We're already seeing that. Spending contracts. We're already seeing that. If you look at the jobs, yes, unemployment's at an all-time low, but employment participation has not gone up. It's actually dropping. If you look at the fact that there's 45% new job openings in the last 2 years, but there's been zero increase in the amount of people hired. So openings, but no one filling the spots. There's a lot of these things going on that say that companies, the economy is not showing an improving economy versus what the market's doing. And in fact, the risk is greater of these things on the screen occurring. And so what's happening now is we're seeing a liquidation in the stock market. Smart money is getting out. And you're going to see this here when we get to the technicals. But smart money is getting out, and this is called the distribution stage, where smart money sells to you. Once the public then realizes and they catch on, they start selling. When they start selling, they sell ETFs. They sell their mutual funds, their IRAs, and it all starts to fall apart. There's no buyers, and these vacuums create. And this vacuum comes from one of the largest problems of all, which is, of course, the amount of speculated value in the economy. So if you want a great read, you go pick up a book called Juggling Dynamite by Danielle Parks. It's a really good book, but she talks about the fact that of this huge amount of speculation in the economy. So how does speculation occur? Well, I mean, it's like you coming to me and saying, "Hey, Bank of Johnny, I'm going to give you $1,000. Could you stick that away there in your safety deposit box for me and give me 2% interest?" I say, "Yeah, no worries, mate. I'll do that for you." Then I take your $1,000. Then I go to the bank next door and I say, "Hey, I've got $1,000. Would you lend me $10,000 on my 1,000 collateral?" Sure. Bank does that. They take then I take the $10,000 that they give me, take it to another bank, and I say, hey, can you lend me 10 times that? They give me $100,000. So now, based on $1,000, we have $100,000 of speculated value now in my hand. So, I mean, this is how Lehman collapsed, and so basically, this is where the $600 trillion comes from. Now, if you want to know how big this figure is, it's astronomical. So if you go and take all of the real estate in all of the world, that's smaller than that number. Scary, huh? So these are the threats. So as this starts to collapse, as the smart money realizes this, high P to E ratio companies are very susceptible to drops. They're the heightened level of threat. Pardon me. And companies go into survival mode. We're seeing that in the hiring practices. We're seeing that in weak companies trying to now merge to rickshaw up their protection. And this is all coming to a head right now. So that's the idea. We're basically saying, aha, the apple is rotten. But when does it fall from the tree? How do we start to take these ideas and funnel them into tradable opportunities where we can get the timing right? Now, because most people have good ideas. Most people get ideas from the newspaper, friends, newsletters and brokers, things they're familiar with. But how do we then start putting that into a rational process to quantify the idea? If we don't do that, if we purely buy based on ideas, we're going to fall into all these mistakes. So what I'd like to take you through now that we've set the tone or the environment of these ideas, let's now talk about how we put these into a model where we can make decisions based on numbers versus feelings or emotional decision making. So we'll go over to the charts for that. Okay, so firstly, let's talk about the patterns, the technical patterns of the market. Now, as technical analysts, this is, of course, one of the most important things to pay attention to, because 80% of the volume in the market comes from algorithmic trading, and algorithmic trading makes its decisions based on patterns. So to ignore the patterns or not understand them would be to be ignoring 80% of the probability of you being right. So let's start with that probability, and let's go to a weekly chart of the S&P 500 and see what that tells us. So here's the S&P. Has everyone got this on their screen? Just to make sure everyone's got that. See? Good stuff. Alrighty. So let's go back and have a look at what the patterns tell us. So there's 10 years. Now we're going to go to a weekly chart because we're looking at big movements. Let's start with what happened in 2007, 2008. Hopefully we all learned something from then, or as Bush would say, fool me once, shame on you. Fool me twice. Fool me once, you can't be fooled again. Well, let's not be fooled again. If we look at the market in 2003, 2007, and I make that reference because someone in the audience was talking about Bush. But look at the rally. Now, from 2003 to 2007, we had an upward channel, which, yes, is technically bullish in the sense that it's an uptrend, but the high probability of an upward channel is that it will break down. So when I see an upward channel, I consider it bearish because the way I trade it is waiting for the break to short the hell out of it. So anyway, there's your upward channel. Now, when did that break? That upward channel was broken, in other words, stopped working on April 2007. And that is the exact date that the crash began. Not 2008, 2007, because that was when we got our first head and shoulders pattern. And this is a head and shoulders ranks number 1 out of 100 technical patterns, ranks number 1 as the best bearish pattern in a bull market. It usually indicates the tops of rallies because it tricks you into thinking it's going higher, by when the head makes a new high and then it all falls apart. Perfect for the smart money to sell their positions to you. So you see that head and shoulders there, up left shoulder, head, right shoulder, and then look at that. We measure the head to the neckline, duplicate that. That's exactly where the market then broke down to, January 2008. Then we got another head and shoulders, both of these with declining necklines, which makes it even more probable. Okay, there's your second head and shoulders. Let's measure. Head to neckline. Aha. Drops exactly to that level again, and that's where resistance then becomes. Okay? And then as we bottom out, we create an upside down head and shoulders or an inverse head and shoulders with an inclining neckline. A very powerful long pattern. And look at where he went to, the head to the neckline. Right, exactly where it rallied to. So if you thought 2008 was chaotic, it wasn't. It was actually as perfectly orchestrated and as you could possibly get. For a technical analyst, I mean, from 2007, the market behaved like a well-disciplined child. It went to exactly where the pattern said it should, and it performed as graphically as impressive as you could ask for, as well as the reversal. So this is why a focus on patterns plays such an important role in my analysis. So now let's look forward. Let's see where we've gone from there. And before we do that, I'll draw your attention to one other key factor that was going on in this time frame that's relevant to today as well, which is money flow. And what you've basically got here is a accumulation or a recipe of all the good stuff, right? Because most people think that an uptrend is defined by higher highs and higher lows. That's incorrect. It's very misleading anyway. And for those of you who've heard me talk about this before, I apologize for the duplication, but I'll explain this quickly for those of you who haven't. You would never buy a stock that was making higher highs and higher lows, but contracting in range. You would never buy a stock that is got if you could find a stock that looked like this, you've now identified an extremely probable short. So don't tell me that's an uptrend, because that's a beautiful short pattern. So what I'm getting at is that you've got to get the right kind of combination between all the factors that actually define a proper uptrend. Right? So that uptrend needs to have higher highs and higher lows, higher volume as it goes up, and closes in the top half of the range, and ideally an expanding range as well. Now, for that reason, people add all these complex indicators to their chart. They use stochastics for the highs and lows, the directional movement, ease of movement, on-balance volume. You don't need all that stuff. It's noise. What you want to do is simply look at this indicator, because it actually takes everything that we've just discussed and puts it in the format of one indicator, money flow. And if all those things are happening, in other words, if we have a real uptrend, money flow goes up. And if we don't, it goes down. So what do you notice about this period in the market? As the market has been going up and creating these head and shoulder patterns, money flow is making substantially lower highs and lower lows. In other words, we have divergence, a very powerful indicator. And that was one of the other key signals that told us, short the hell out of this market. This was the big one. Now, why do we have the next big one? Well, let's fast forward now. Let's fast forward, and let's just get that out of the way for a second. If we look at the S&P 500, we have yet another several-year upward trend channel. When does that channel stop working? Right there. Why does it stop working? Because it stops hugging the top line. We then go down, and you can see that we're now bouncing off of this trend line. Okay, and we rallied up into it. we broke down, and you can see we've broken the channel to the downside. There you go, right there. We'll zoom in. Oops. Yeah, I'm just going to get rid of this. We'll add those back on later. So you can see it's gone up, it's broken the up channel, tested from beneath, and failed. Okay, so those are some key factors so far. So we've got a bearish pattern. Let's look at the money flow. What's the money flow doing since May 2014? Money flow, just like in 2008, is making lower highs and lower lows, just like before. Okay, and what kind of pattern, therefore, could be forming? What kind of pattern may we be building? Well, if we look at the daily chart, we could quite possibly be building a downward neckline, head and shoulder as well, just like last time. Left shoulder, head. Okay, now if that were the case, let's just fill in the blanks. Let's see what that would look like if this were the case. So what do? We measure from the neck, pardon me, we measure from the neck to the head, and we'll just zoom out a little bit. So there's the neck to the head, and let's draw this chart in, because that's what you really want to be doing. Once the head and shoulders is there, you're too late. So let's anticipate the chart instead of reacting to it. So if this is a head and shoulders, what will that look like? That means we get a breakdown from somewhere around here, and we'd be looking to, let's say, there we go. So we're looking for a break somewhere around here. So we're looking at this level here around 1600 to 1550, somewhere in that range, depending on where we break down from. So if we break down from there or there, that's going to affect the target. Okay, that's our first checkpoint. Let's then actually do a Fibonacci extension from the highs to the low. In other words, from resistance to support. Let's extend that zone out. You can see that 1600. That's where that extension tells us. There we go, 1600. Okay, there's our extension. Let's delete that. Let's now go from a Fibonacci retracement from October 2011. 50% Fibonacci, where is it? 1600. Okay? Let's now check about the entire zone from the lows back here. Where's our 38.2% Fibonacci? 1600. You have correlation of 3 different Fibonaccis, both combining an extension of the recent drop, as well as the most important time frames over the last 10 years for Fibonacci retracements, and they all align at the exact place that the head and shoulders correlates with. Now, this doesn't mean that we have an absolute scenario where the market would crash. But what we do have are all of the technical rules that, had you followed them, you would have made a bucket load of money in them in 2008. Okay? If we don't follow rules, you're never going to get consistency ever. If you don't have consistent variables to make decisions with, quantifiable systems, you'll never make money. It'll just be a random correlation of events. So no matter whether I think that the Fed will never let the market break down, no matter if I think that the economy will recover, that doesn't matter, because right now what the numbers are telling me is that we have the same setup as we did in 08, almost by every single variable we've looked at so far. But you know what? That's still just my opinion. Let's have a look at what the smart money is doing with their money exactly. So how do we look at that? Well, let's go one step further. Let's go beyond technical analysis. Let's go beyond the 80% probability patterns. Let's go into the bonds, because high yield bonds, corporate bonds, treasury bonds, who trades bonds? Not me. Not you, probably. It's major corporations. In fact, most of the bond traders are Federal Reserves or the Fortune 500 company CEOs of the CEOs of Fortune 500 companies around the world, right? So if you want to know who's buying and selling these types of things, it's the guys who own the companies that make up the Dow and the S&P 500. It's the guys who know where the world's going because they're on the front end of it, knowing what the earnings and things are going to be like well before anyone else. And that's how they move their smart money around, is into the market, out of their own companies, into bonds, whatever the case might be. Now, if smart money likes the stock market, in other words, if the smart money believes that that we've got a healthy corporate market and things are going to be great, and this is the best time to be buying stock, corporate high-yield bonds go up. Now, the market's been rallying. What have corporate high-yield bonds been doing? Everybody? Falling. So the smartest money there is in the world doesn't buy it. They don't buy the rally. They're selling the rally, at this point anyway. And until the technicals change, this is my direction. Now, this all actually aligned perfectly at the end of July. We did a big one in July. Go back to the S&P 500. At the end of July, we said, short the hell out of this market, and made significant profit. Most of the positions we picked did a 300 to 500% return in the following 2 weeks after we hosted an event just like this. On this date, August the 6th, we held this event, this very same event, and said the very same things we're saying now. We said that, look, all these factors are happening, and we're about to break out of a consolidation pattern and collapse. And we did. The positions we traded as a result, LVS, over a 500% profit on the options we picked from August 6th down. Straight down drop. PII, Polaris, still holding these puts. This has been a high three-digit return. I think it's 500 or 600 at this point now. But they've had a significant drop from where we found those as well in August. What else? UVXY, 600% return in a week. Buying calls on the UVXY right around the 6th of August. Okay. Now, so this is timing. We are about to run into probably the exact same scenario come the first week of December. So what we're doing now is preparing for this and putting together the best possible trades to replicate similar returns, we hope. If the technicals change, then we'll reverse our position in a heartbeat. But right now, that's what we're seeing. So does that make sense so far? Does everyone get the thought process of how we're putting together the macros, the technicals, the pattern, and we're seeing the same patterns as before? Good. Now, there's a question about seasonals, the Christmas rally, things like that. Once again, I don't care about anything that you could read in English, if that makes sense. I don't listen to the news. I don't care what company it is that I'm shorting. I don't care who runs it. I don't care what time of the year it is, what day of the month. All I care about is where is the money going. So you might say to me, but hang on, what about the seasonals? Don't you buy into the seasonals? Sure. I love trends and I love patterns. But if the smart money doesn't believe the seasonals right now, why would I? So again, the focus is I don't care why something goes up or down. All I care about is where the money's going. Who's seen that movie 2012 with John Cusack and Woody Harrelson? It's a movie about the end of the world. And there's a scene where Woody Harrelson, if you can picture this, he's standing on top of this mountain in Yosemite Park. And he's got a radio backpack on his back, and he's screaming out, you know, the end of the world is coming, the end of the world is coming. And anyway, as he's standing on the top of the hill, there's all of these thousands of animals running in one direction. Now, a few minutes later, so everyone else is standing there looking at this happening, going, gee, what's going on? A few minutes later, they're all dead because the earth caves in. Now, it's the same thing with the stock market. Quite often, you're standing there looking at all this money flowing in one direction, and you say, oh, gee, I wonder why that's happening. The stock market seems to be going okay. Why is all the smart money selling? By the time you figure it out, the earth has already caved in. If you see if you can draw the analogy, we don't want to wait to see what everyone's running away from. They know, we don't. And what I'm seeing here is that same money flowing out currently. Again, that could change, but right now that's what that's saying. Okay, so one final factor before we get into looking at some stocks and so forth that kind of corroborates all of what we've just talked about is to then just get an idea of breaking it down to a company by company basis. So we're looking at bondholders, we're looking at the smart money in the S&P. Let's look at the insiders individually and see what that says. So this is one little final checkpoint you can use to say, hey, what's up? And for that, we're going to go to FinViz. Now, excellent website for anyone who hasn't used this site before, just to get a very quick snapshot of what the stock market's doing. So we go to FinViz, and we'll just click on Insider. And you can see here a quick snapshot of what the people that own the companies that drive the market are doing with their own stock. So this is the latest insider trading. So this is just ordered in terms of most recent. Red, of course, is sell. Green is buy. What do you see here? Confidence or fear? I don't see many people confident in their own companies, let alone the stock market. Let's look at the top insider trading. What do you see there? Do you see a plethora of excitement about how well their own companies are going to do? But you know what? Maybe they're wrong as well. Let's look at the people that own the most amount of stock in the largest corporations of the world. What are they doing? Geez. And I was about to take a mortgage out of my house and buy mutual funds tomorrow. Guess I better not do that anymore. Look, I mean, you see my point. This is a significant amount of evidence stacking up against the market. So look, even if we just take a neutral standpoint on this, is this the time to be getting excited, or is any bullish activity we have left simply a short squeeze? You know, I'm not saying there might not be a further move up, but what I'm saying is with all of this evidence stacking, we should be prepared that when the market breaks, not if, but when, are you positioned to take advantage of what could be the best opportunity to double or triple your account by having, or what money you put in anyway, by having carefully selected options in stocks that are just set to crumble? And there will be stocks that do that. There are already stocks doing that now. So that's what this is all about, is preparing for, again, what could be a terrific money-making opportunity. Not that I want the market to crash, but if it does, I want to be richer at the end of it. I'd like you to be as well. So look, I mean, here's two stocks that I'll share with you right now. Now, this is the first one that we picked actually just a week ago. This is now the people who have got into this. We alerted this out to a special group of our members on Wednesday, November 18th. Let's have a look at why. Does anyone know what pattern that is? Question from Rich. Do I see scheduled selling for tax loss? Yes, there certainly will be tax loss selling at the end of the year. The smart money markets will be selling their winning positions, getting ready for the shorting opportunity too. Anyway, yeah, rising wedge. Thanks, everybody. Rising wedge, which has a 68% probability of breaking down. Okay, so do we have the pattern? Now let's look at the money flow. What does everybody see the smart money doing when we look at LGF? What does the smart money think of LGF as it rallies up? Selling. Substantial divergence. In fact, we broke negative right there. So we have a bearish pattern, a macro bearish pattern, divergence. Okay, good enough. Let's have a look at the insiders, those cheeky guys. Right? Let's have a look. Now, I won't use Finvis for that. I'll use Insider Cow. Funny name, but a great website. Over to Insider Cow, and let's punch it in. LGF. That doesn't look very good, does it? 7.8 million shares at $39. So billions of dollars of insider selling. Not a great vote of confidence, is it? And then we go back to earlier in the year, more selling. We look at the relevance of the price. It's at $33, $31, $37, $36. So the insiders feel that $30 is good valuation considering the risk and what's going on with the company. Well, also very odd to see that amount of selling when you're looking at a company with a P/E ratio of 44. That's pretty damn high. Usually a company has high P/E ratios because they're expected to make so much money in the coming years. Again, if you're expected to make so much money and you owned that company, you wouldn't sell it, would you? You'd be buying more because of how much money you're going to make next year, not selling as much as you can in massive lump sums. So whenever you see a high P/E ratio of this level of selling, that's another really red alert. Okay, so we've got a myriad of wonderful factors here saying short. So we said, right, pick up some $35, $34 puts. And those have gone up about 25% a day, every day, since we alerted it. So it's about, I think they're up 50 to 75% now in a market that's going up, and it's still going down. These are beautiful technical patterns. Here was another one that looked just like this, actually, Acadia Healthcare. ACHC, another one we picked the last time we felt these factors were accumulating. Again, look, there's your rising wedge. There's the smart money flow divergence. And there's your drop. There's your breakout. And we alerted people to that back in August. Stock dropped from $80 to $60. How much money you could have made just buying $70 puts a few months out of the money. Hunger Games isn't doing well. Hunger Games is not doing well at all. In fact, they had a very lackluster opening weekend. There's another thing. So these are some of the factors that go into creating a perfect recipe for a short. Here's another one. I'll give you one more that we're in right now. I just bought a bunch of puts on this yesterday. Or the day before, I can't remember. Anyway, I'm a day ahead here in Australia, so I lose track of time trying to convert the different worldwide time zones. Anyway, look at this stock. This is just one other I'll give you that I'm holding a bunch of puts on right now. I bought the $35 March puts for what was it, 80 cents. No, it was $1.70. I bought them for $1.70 for $35 puts that don't expire till next year, middle of next year. That's plenty of time. Let's have a look at the factors that go into this one. All right. Well, what have we got going on? There we go. We have a breakdown. Here we go. There we go. There's your rising wedge. It's already broken down. Let's have a look at the moving averages. We'll go back to my default screen here. Okie dokie. So let's just have a quick look at the moving averages, and we'll look for signs of negative momentum. There we go. So we've broken down out of that rising wedge. We've broken down underneath the resistance. The moving averages are now rolling over on top of it. Money flow divergence is there. Great. Okay, now let's have a look at the insiders. Okay, IMAX. What do you see? Is that an encouraging sign? We've got the 10% owner annuity trust, the chief administrative officer, the CEO, the chief technology officer, the chief legal counsel and business development, the president of IMAX Theatres, the senior vice president of finance and controller, the executive vice president of human resources. The list goes on. Everyone that you could have a fairly good idea of what the company is doing is selling. Doesn't look good. So this is the kind of thing. Pardon me. If we look at where it came from, you know, come February of next year, it could be a $10 stock, right? So my puts that I got for $1.80 could be worth $20 easily come March next year. So for every $1,000 I put into those options, I stand to make $10,000. Right? Not a bad trade, considering there's very little upside potential on the stock. Worst case scenario, I get out with a small loss on the options. These are the kind of trades that we call big ones. So yeah, it's nice to our core business at Acorn is to make 8 to 10% move on a stock over a 2-3 week period. We're very good at that. But when we start to see a special situation like we are out in the market now, this is where we start to adopt some longer-term positions. I would never buy long-term puts. I'm not a long-term guy, but this is just one of those scenarios where things are so perfectly set up where we can collect some high-quality short positions that you can just sit on, and the goal is make 300, 400, 500,000% buying these 4 to 6 month out of the money puts. There's a question on a stock called AD. So yeah, that's basically what we're seeing. And by the way, other factors: P to E ratio of 50, and the short float on IMAX is 22%. That's a significant short float for a company as well known as this, trading at the kind of levels they are. Heavy short float. And I told you I don't read the news. Somebody asked me to look up something on IMAX, so I just happened to see the news, and it made me laugh because apparently they're opening up a gym, a fitness center in New York. What the hell is IMAX doing getting into the fitness center business? That doesn't spell businesses booming at all. I mean, what if Acorn started selling vacuum cleaners? You'd be a little curious as to how good we are at picking stocks, wouldn't you? So anyway, short float means how much of the available stock on the market is being bet against. So a quarter of the company, the stock market is betting against that amount of shares. So there's one. There's a question on ADPT. Great question. This is one good at picking up dust. Well, that would be that's the gold ETF, isn't it? DUST. You know you have a sorry life when you start making stock market symbol jokes. Anyway, ADPT. Okay, great example. This one is one that we selected as a. This is one that came up in our scan recently, and for all the reasons I just told you, this is one that we bought. I think it was $50 puts on ADPT. Again, look at this. declining neckline, head and shoulders, high probability pattern, money flow coming right out of the stock. Beautiful. Let's have a look at the insiders. There we go, ADPT. You're going to see the exact same thing that I've just shown you on these other stocks. So the person asking the question, I'm not sure if you heard about this from us in our alerts or whether you found this on your own, but if you found it on your own, great job. Again, look, 52 P to E ratio, massive insider selling in August from a wide range of people as well as the 10% owners, as well as in May. Right? So now let's go and have a look at the chart. That's right there basically in August that was all going on. So we said, right, let's load up on puts. So we did. And a week later, the stock plummeted 22.33%, and we sold the puts immediately. Sent out a text message to all of our students, letting them know, and an email, and took out for about 120% profit over a week. Could this be a another opportunity to short it? Sure, but I would wait for it to break back down into that downward channel. Sell resistance, buy support. So this could become a two-header complex head and shoulders, which means there's a potential for it to rally to 74. Should it? No, I think it's a dog. I think it should crash to 25, but that doesn't mean it won't rally to 75 first. And that's where timing comes into play. So I would wait for this to break first before getting back into it, but it's definitely on my watch list along with a bunch of others. John, would one expect a rally based on heavy short positions, i.e. IMAX? 24% isn't high enough to create a short squeeze yet. I don't think. I think it's just because the shorts, the fact hasn't caught up with the fiction yet. That's why the chart's still going up. That's why it's a consolidating rising wedge. It's only just starting to break. I mean, this trade, I would not exit this position unless this trend line was broken. So even if it went up to 40, it's still a very valid short. In fact, if it went up to 40 or 41, I'd double my position. So, I mean, there's a comment. IMAX is experimenting with virtual reality with stationary bikes. Yeah, I don't think that's going to save their business. That type of stuff takes a while to catch on. Look at the Google Watch. Anyone here own one of those? I mean, they spent the last 10 years convincing people not to wear watches and to use your iPhone, the Apple Watch, sorry, and then they launch a watch. I mean, it takes, people don't adapt technology that quickly. I don't think that's going to make a difference. Highly disagree with, anyway. So, all right. John, there are many folks indicating this is the mother of all bubbles. Would you agree with that? Well, that's why we call today's webinar the big one. I think so, absolutely. Look, as someone who cares about the economy, I don't want to see people lose jobs. I don't want to see the market collapse. But if it does, I'll probably make 10 times my portfolio in the next 12 months. So if it doesn't, fine. Well, we're still trading long. I mean, I bought calls just the other day in VTL. Google Watch, head shake, yeah. Sorry, Apple Watch, you're exactly right. Yeah, I mean, VTL, opposite scenario. Look at that. Sideways consolidation, money flow shooting up, insiders buying. I'll still buy stocks in the mother of all bubbles if the charts tell me to, but I'm well positioned to take advantage of a massive decline. So let's talk about that for a moment, then we'll go back to more questions. So as I said, this is what we consider to be the big one. Whether we're right or wrong, if we ignore the factors that are telling us to short right now, we would be ignoring the factors that have made me money in my trading career for the last 12 years. So that would be, I have to go with the rules, and that's what the rules tell us. So now the question now becomes, how do we take advantage of that? What do we do with that knowledge? And the answer is we start looking for the highest probability opportunities, right? So this is scanning. So we have to think about what makes the perfect short, and we start defining that. Just like at the beginning, we talked about the stock making higher highs and higher lows, but contracting in range, low closes, volume dropping. That's what you want to do. You want to create a recipe of what you're looking for. Just like if you go shopping, you know what ingredients go into what you're cooking. You wouldn't be a very good cook if you just guessed random variables. You've got to know what you're shopping for. And if you're trading and you want to make a career out of trading, this is the most important part to get right. Define exactly what chart you're looking for and what variables to confirm it. And once we put that all together, then we can develop a scan. So each day when I sit down in front of the screen in the back, which is currently down at the table in the back of my camper van, I can open my laptop up, I run my scan, and within about 20-30 minutes, I know exactly what stock I'm buying and selling and what positions I'm getting in or out of. That's how much work I do to manage the entire portfolio and the company's portfolio. 20-30 minutes a night. The reason why is because I know exactly what I'm looking for, and it takes all of about 10 seconds to scan for it. What I'm left with is the 10 best possible positions that meet the criteria I'm looking for, and I analyze those. That's why it's so short. If it doesn't come up in my scan, there still could be other good trades out there, but they're not the best, if you see what I mean. And that's important for me. Stick to the rules. So this webinar has been all about the crash. So the pitch, because I was getting to one, is this. This is the best, this is the highest value versus cost product we have. We only launched it just recently when I got together with Jeanette, and Jeanette said, look, we've got a ton of people who want to hear you speak in this event coming up, and I'd like you to offer something of high value to them. I said, great, well, what does your audience want? She said, Jeanette said, whatever's going to make them the most amount of money. So here it is. This is basically an 8-hour course that teaches you the strategy and scan that we use to identify stocks that have peaked, that have had these high P/E ratios, insider selling, all the things that I talked to you about today that found me ADPT, that found me IMAX, that found me these trades. It's going to you're going to be able to do, like I do, click one button and have those stocks in front of you every night within 10 seconds. Okay, and then over the rest of the hours in this course, we're going to teach you what to do with that list, right? So a list of stocks is useless unless you then know how to action those trades. How do you identify the pattern? How do you identify support and resistance properly? There is a correct way to draw trend lines. How do you know when one trend begins and another one ends? So many times I see people making the mistake. And I don't blame them, but people make the mistake of doing, this. They start connecting these two lines, and then they start connecting these lines, and they start connecting, these lines. And does anyone here struggle with that? They say, how the hell do you know which trend line is correct? Right? People make that mistake all the time. The thing is if you don't know where the trend lines are, and they are not subjective, they're objective. The trend lines are there. You either see them or you don't. You either draw them correctly or you do it wrong. But there is a correct way to draw trend lines. And once you know it, and once you've drawn them on, then you can take the stock off the screen and you'll be left with a pattern. Once you know the pattern, then you know what the rules are. There are rules for every pattern. No guesswork, rules. There are rules for the pattern, and then you know exactly how to trade it. So this all comes back to getting the basics right. But this is what we go through and throughout the course is obviously teaching you the very high probability scan, which is called capturing the crash, the perfect storm. So you get that, we give you the tools and the software and everything you need included. Run the scan, 10 stocks on your screen, go through each of those 10 and say, right, what's the pattern? Is it a very high probability pattern like a head and shoulders or a descending triangle or whatever the case? What are the rules for entry, for exit? How do we measure that? How do we calculate the risk reward? How do we position size? What options might we buy? All of that's covered. So it's really awesome stuff. And that's the link. So you just go to acornwealthcorp.com/crash. And look, scanning. If I couldn't scan, I wouldn't trade. It means that every day I sit down, I know that my job starts and finishes with a scan. So if it's not in my scan, I simply close the laptop down and wait for the next day, because it's got all of the best qualities. Somebody asked me just today. I'll give you a great example of the mentality that I trade with. Right? Somebody asked me today, "Hey John, what do you think about Starbucks?" Just a warning, we only have about 6 minutes left. So if you have any questions, we do have 6 minutes, 6 to 10 minutes or so to answer them. So let's have a look at Starbucks. Somebody said to me, well, John, what do you think of Starbucks? Would you short this? Well, it has broken down out of its uptrend. If we look at the moving averages, you can see the 20-day moving average is fairly important to this stock. But, so are we in an uptrend or a downtrend? We're in a downtrend because we're under resistance. No thought, pure technicals. We are in a downtrend because we're under resistance. Okay, but would we short it? Well, the money flow is still positive, so no, right? Because ask yourself a very simple question. Would you prefer to short this stock, or would you prefer to short a stock that looked like that, where the money flow was significantly negative? Would you, everyone? The question is pretty self-explanatory. Obviously, you'd short option 2, and you do have that choice. Why the hell would you short a stock that wasn't perfect when you could short a stock that is? The answer for that is, well, you don't know where that one is. You don't know what that stock is because you haven't seen it yet. So I put it to you that when you have scans, you can find one that looks like this with significant money flow every day or every couple of days, because your scan can find that. So instead of trading the stock because you know about it, you trade the stock because it has all of the perfect scenarios built into it that makes it a rotten apple ready to drop. Option 2 for this guy. I agree with you, Pig Soup. Yes, and Starbucks is widely owned and yeah, big market maker. So yeah, I wouldn't touch it for a short, and I wouldn't touch it for a long either. How about Amazon? Same story. Amazon's got massive insider selling. It actually came up in our Capturing the Crash scan 3 days ago. But upon further analysis, the money flow isn't perfect. Again, compare Amazon's money flow to IMAX, which, based on technicals, looks more bearish to you. Now, we're just comparing 2 stocks. The purpose of the scanner every day is to compare 8,000. When you can analyze 8,000 stocks a day, you get to be real damn picky about what you're looking for. Think of it this way: if you were going to go hire a personal assistant, or whatever you do, whatever you do in your job, let's say that you had to hire somebody to help you. Now, if you can only interview 20, 30, 40 people, even that's a lot. I mean, obviously, you're going to get the best of 30 or 40, and that's what you're going to have to compromise on. Imagine you could interview 8,000 every single time. You're going to get a very high caliber or whoever ends up through that process. Same thing with scanning. The idea is to just be completely really tight about the what we're looking for. It has to be perfect. So I think that Amazon is the same scenario as Starbucks, very powerful market maker behind it, and the money flow just isn't perfect. And if it's not perfect, I'm not going to touch it. So you'll learn all of this in the course. Look, I mean, as traders, just to be blunt, you probably risk thousands of dollars a day in every decision you make in the market. If you're just getting started, even more so, the risk is even greater if you don't make good decisions to wipe out. So I hope you can see that for $97, hopefully, this is a great handshake for you to get to know us and see we mean business. And this is where you're going to learn how to take advantage of these great opportunities. And then the scan, of course, you keep for life. So if it saves 1 hour of your time, it's already paid for itself if you value that time that way. Let's have a look at the questions. What platforms are the scans written for? We give you one which will work on any computer, and you don't have to pay for that. It's included. But we've also got scans developed, a special setup we designed for FinViz, so you can use that if you don't want to use the software. But it's also designed in incredible charts, Metastock, TC2000, Think or Swim, TradeStation, I believe, just got finished being developed, and the Twigs money flow is available in all those platforms as well. Earlier in the session, Earlier in the session, what did you chart to represent corporate bonds? The answer for that is HYG, Harriet. Excuse me, I'll use correct phonetics. Hotel Yankee Golf. Imagine that, an Australian talking properly. We're going to have our own language down here, I've been realising. Okay, question. The trend was down on those bonds. How does that indicate that stocks are bearish? Well, if you're betting on business, you are buying, the smart money buys high-yield corporate bonds. Because businesses do well, the bonds yield a good return. If they assume business is not going to do well, no one wants to put money into businesses. They want to put money into mattresses, under mattresses, I should say. So if the market goes up, and that indicates confidence is strong in the market as well, both should go up together. In fact, and that's why, if you actually look at the longer term trend, you'll see that's reflected. We'll go back over 8 years. Look at where this trend began. So if you look at the stock market's gone nowhere but up. Smart money have been offloading the stock market since 2013. When you are the smart money, when you're controlling billions and billions and billions of dollars, you can't just sell tomorrow. It's a slow exodus. You also, ethically, I mean, my dad runs several companies. He runs one of the largest lithium mines in the world, and he's a brilliantly ethical person. He would never sell a company that he owned if bad news was coming, because he said it wouldn't be fair to the shareholders if they couldn't get out first. And that's how business should be. So if you are the smart money, you're not going to be offloading a bucket of stock right before a massive breakdown. It wouldn't be right. So it's a very slow process where the Titanic turns. And you can see that smart money has not liked this market really since quantitative easing started to become ridiculous in 2013. And you've seen that dropping ever since. So that's the longer term divergence that shows you money not betting on business. When do I think the S&P 500 will reach 1600? I'm thinking by March at the latest. So that's why I'm buying May, June, July puts. Yes, I won't make as much, but I get to buy that time, and that I don't have to worry about it. I don't have to look at my positions every day. I can just get in, set my stop loss, and forget about them, which is how I trade. What is my take on the gold market? I wouldn't buy it yet. The gold market very closely follows a 161-day exponential moving average, and I would not be buying any gold of any significant level until we are above it. As a short-term trade, I would need to see the 20 and 9-day moving average cross. But let's take those off for a second, and let's look at the more important level, the 161-day exponential. That is the key level gold has to get above. It has to get above 1140 for me to have any long-term interest. There you go. There's gold. Look at that 161-day exponential moving average. Fits like a glove. I almost put up my Jim Carrey impersonation on for that little line. Stock trader and movie buff, my two favorite things. Look, no matter what you trade, there's a question there, whether it's commodities and everything. What you'll learn in this course and what the scan works with is everything. It's not because we don't care whether it's commodities, stocks, the euro, doesn't matter. Futures. What we're doing is we're tracking how money moves and the patterns that dictate what's next. So no matter what vehicle you trade, this covers it. How much time do we have left, Jeanette?
Hey, John, you could go for, I see there's a lot of questions. You could go maybe another 5 minutes and then we'll wrap it up.
All right. Well, since you're such an awesome crowd, I'm going to give you one little extra freebie. So if you're not convinced yet, here's something that blows me away. Who would like to learn a strategy that predicts where the S&P 500 will go to next 80% of the time correctly? Anyone? All right. It's covered in this course. There's a whole, I think, an hour and a half, maybe 2 hours on this topic alone. So I'll give you a little sneak preview. It's called Open Range. So I'll use my last 5 minutes to share this with you. There's 2 days of the month where the market makers tell you where the S&P will go next. It's the way that smart money communicates technically. Basically, it's the first trading day of the month and the third Friday, which of course is options expiration. So let's go to here. So we basically we look at the first trading day of November, for example. Bang, right there. And the range of that day, the high and the low, is called open range. Now, what we then look for is whether the market closes 3 points or more above or below that range. And if it does, that's the bias and direction of the S&P until the next open range day. So as soon as we saw the S&P 500 close below that range on Monday, November 9th, that was the sign to go short. The same thing occurred on August. First trading day of August. That was the open range right there. Broke below it. Along with all those other factors we already said, that said short. Right? Look at all the key days. There we go. First trading day of October. Open range. There. Broke above it. Said to go long. Huge rally. So we cashed in a lot of our shorts and went long. Even though we're expecting the market to crash, we took advantage of the short-term opportunities. Now, if you go, I went back in one of the lessons. I actually go back. Every open range instance, over the last 28 times it's occurred, and it's over 80% accurate when you apply the rules that we teach you to confirm it. So you'll see that it adds huge probability. If you can predict where the market will go for the next 2-3 weeks, 80% of the time correctly, that adds a huge element of probability to your trading. So just for that, I mean, you'll get that in the workshop as well. I think we're about done on time, so I'll answer the last couple of questions. So acornwealthcorp.com/crash. There's a comment that you can't find the $97 offer on our site. No, we do not offer it on our site. This course sells for $497. We do not offer this price anywhere other than in this special webinar. So you won't find it on the site or anywhere else. It's normally $497 if you were to call in and ask to purchase it that way. It's 8 hours of training. It's huge amount of stuff in there. Do we have a regular newsletter? Sure do. When you sign up for the workshop, you'll be given an option to try us out for $9 for a month. And what that gives you is a newsletter every day and a 5 to 10 minute video every day of me telling you what I'm going to buy tomorrow, going through the charts, the insiders, the probabilities. So what I'm doing is I'm running this very scan that you're learning now. I'm doing that. And then I tell you which stocks I'm buying the next day from that scan, what options, everything. So this is stuff I use my own money on every day. So while you're learning it, you'll see us practicing what we preach with our trading account. That's $9 for a full month. You get a video every day, as well as the workshops, as well as the newsletter. To register, you have to go to acornwealthcorp.com/crash. I'll pop it in the chat box. If you have any problems, you can always give us a call or a ring. If you missed the $9 option, just simply give us an email, shoot us an email and tell us to add it for you, and we will add it for you. So, yeah, ladies and gentlemen, I mean, I might be completely wrong. I have known to be once or twice in my life. As you can ask my beautiful girlfriend, I'm sure we quickly confirm that. But trading isn't about being right or wrong. If I can summarize today, trading is about the rules. Don't ever worry about whether you're right or wrong. That is impossible to know. And it's unnecessary anxiety, unnecessary fear. None of these things have a place in trading. Trading is about calculations and strategy. And, surprisingly, simplicity. And so that is what everything we do encompasses. I'm not worried about whether we're right or wrong. I simply ask myself, is this following all the rules? And this big one strategy absolutely is. With that, of course, timing-wise, for all of you taking this course, it is coming up to the absolute perfect time to implement, because, of course, right around the corner, remember, only have about 1.5 trading days really until open range of December, the 1st of December, and that could be where all of this falls apart. So we've got 3 days really to prepare for what we're going to buy puts in and short should the castle come crumbling down. There's the link in the chat box. If again anything else we've missed, you can always email us, and yes, we'll and you'll get instant access to this course. It will be emailed to you today, all 4 sessions, and you can get going on immediately. Okay. I'm an Aussie that's set up. Yeah, absolutely. I'm all over the place. All right. For how long? Forever. Once you've got the course, you own it, and every few months we record a new version of it, and you are able to get access to that for life. Okay. Ladies and gentlemen, it's been a real pleasure. I love talking about stocks, and It's great to have the feedback and participation you've all had. So I'd like to give a big thank you to everyone here who stuck around to hear me talk, and obviously a big thank you to my good friend and colleague Jeanette and everyone over at TradeThirsty for putting on such an awesome event. Thank you all, and I hope to see you all in the live sessions coming up. Jeanette, over to you.
All right, John, thanks. And I'd like to thank everybody for joining us tonight. I just want to remind you guys that we have another event coming up. It'll be our final event of the year, and we've stacked it full of a lot of great speakers, including John. John will be back with another topic next month. And so let me put it in. There it is. Okay. All right. So December 19th from 9 to 4. It's going to be a long Saturday full of a lot of great speakers. Hubert's actually going to be on here. Rob Hoffman, Price Headley, Todd Gordon, Josh Martinez, Larry Gaines, John Seville. So we're talking about stocks, futures, options, commodities, specific indicators, technical analysis, fundamental analysis. So many different topics that are going to be kicked out on this, what we are calling our final Toast to Traders December Bash, December 19th. Mark your calendar. Watch for the email that will have your recordings from today's event, and it will also be posted on the website at TradeThirsty.com. We urge you to go there and look at all of the content that our great speakers provide on a daily basis, and we'll see you in our next event in December. Y'all have a happy holiday, happy Thanksgiving, and I'll see y'all in a month.